Hello sector watchers, welcome to the show. This is the 133rd episode of Sector Spotlight for Tuesday the 28th of June. I'm recording it on Monday the 27th. My name is Julius de Kempenaer and I am presenting to you from Amsterdam in the Netherlands. Please find my contact details on the screen in case you want to share any of your experiences or provide us with any feedback. Today is the last Tuesday of the month, and the regulars will know that that means that we're going to look at seasonality, which we will do in this show. My plan is to try to align the seasonal patterns, if any, with the equal weight sectors and use the occasion to once again have a look at equal weight and cap-weighted S&P sectors side by side, see if we can find any meaningful differences or anomalies that we can try to benefit from. Anyway, those are the plans for today. Ladies and gentlemen, this is Sector Spotlight. For this occasion, I decided to swap the sequence. And instead of starting with a look at the current rotations, I thought to start with a look at the seasonality and then see if we can blend that in with the current rotations. Just looks like a more meaningful sequence, because I found out that when I do the current rotations first and then look at the seasonality, I always go back to, so when I do the seasonality, I always go back and look at the rotation. So when we first do the seasonality, then we can talk about it when we look at the rotations. Anyway, I hope it makes sense. Here is the table with the percentage of months that the S&P outperformed the S&P 500. If I am going to highlight the month of July, which I've done here, you can see that there's not a lot of outliers, and outliers is what we like to see when we talk about seasonality. Most of this stuff is around 50%. Now there's one at 70, that's real estate. So real estate has outperformed the S&P 500 70% of the occasions over the last 20 years we're looking at. So that's a meaningful number. And 65 is pretty close, and that's for technology. So technology also outperformed the S&P 500 in the month of July 65% of the time. And more interesting maybe is that for technology, the month of August is also 70%. So I try to look a little bit more forward than just 1 month. So the technology seasonal is interesting enough to check out, because it looks that technology is from a seasonal point of view on a good streak. And real estate last month was 55%, this month 70%, and next month 55%. So it also seems to be in a good period of the year looking for outperformance. Now and then we have communication services, which is at 64%, and we've already had communication services on a pretty good streak for the last couple of months, but it just didn't look too well on the RRG with the current rotation. So with 64%, we'll check that out. You may notice that, well, you have noticed that these are all numbers that are on top of the range. So these are sectors that are likely to outperform. And as you know, I also like to look for sectors that are underperforming with a very low reading of that figure. And for this month, there are none. I mean, 45% is the lowest value in the table. And that just doesn't cut it for me. I mean, that's too close to 50%. That's too close to tossing a coin. We're going to check out, from this point of view, we're going to check out communication services, or we're going to talk about communication services, technology, and real estate when we look at the current rotations. There's one other thing that caught my eye, and that is when we move to the average performance, average outperformance for every sector. So this is the number of months where the sector outperformed the S&P 500. It doesn't say anything about the amount of the outperformance. So the other table that we always look at is the average relative performance for each sector versus the S&P 500. And I'm going to highlight the month of July again, and that is here. And then there's one, maybe two that are standing out. And the one that's really standing out is the one for energy. That's minus 2.4. So over the last 20 years, the energy sector in the month of July, on average, underperformed the S&P 500 by 2.4%. Now, the number of months of outperformance wasn't really material, but this minus 2.4, that means something. That is something that I want to investigate, especially when you look 1 month forward to the month of August, where over the last 20 years, the energy sector has underperformed the S&P 500 by 1.7%. So the way I translate it is that the odds for the sector to outperform or underperform are not very significant. But when it is underperforming, it underperforms really, really strong, because you got minus 2.4 and minus 1.7, and I think those are meaningful numbers. The other one that's interesting to check is the real estate sector. And we saw that that sector had high odds of outperforming. And if you now look at the average relative performance, that makes sense, because now you can see that in July, over the last 20 years, the real estate sector outperformed the S&P 500 by 1.6%. And if you look one month forward, then it's at 1.1%. So real estate sector really seems to be in a good period of the year, both from the percentage of months that have outperformed from a seasonal perspective, as well as the average outperformance in percentage terms. So I'm going to check out those sectors, and on the other side, I've got energy with a negative. So I've got the positives and I've got the negative. I'm going to add energy to check out because of the very serious underperformance in the month of July and August from a historical point of view. Now, from seasonality, let's move to the current sector rotation. We have the daily RRG on the right and the weekly on the left, and this is still for the cap-weighted S&P 500 sectors, the universe that we usually talk about here in Sector Spotlight. Just a brief look back at the last 5 trading days. That includes today, so it's Tuesday, Monday to Monday, I have to say, Tuesday to Monday, last 5 trading days. And what you immediately see here is the very long tail for the energy sector, which has been moving from the weakening straight into the lagging quadrant at a very long tail, meaning that there is a lot of power behind this move. Similar, but not as much, for materials, which also came out of the weakening quadrant and rapidly moved into lagging. And then on the opposite side, we've got staples and healthcare moving into the leading quadrant. Especially these moves are still defensive. I know I've been touting about this for many weeks, and it's still the picture that when the going gets tough, it's the defensive sectors that spring to the leading quadrant and come out on top of the lists. There are some changes going on, and I see them, but for the time being, I still see a lot of defensive stuff floating to the surface, which makes me hesitate to go with a full turnaround. We'll talk about the S&P in a minute. But this is what happened last week. The other sectors that you see clustering here in the middle, they're all at very short tails and close to the center of the chart, so not much going on there in terms of last week's rotation. If we move over to the left-hand side of the graph, which is where we have the weekly rotations, you see that the The image, as we've seen it over the last few weeks, is still quite similar. The last observations on pretty much all tails are more or less in line with the trajectory and what you would expect. If we start with energy, then you can see that it is continuing its rotation into the weakening quadrant. And that's obviously backed up by that big move that we saw on that daily RRG. Mind you, on the weekly RRG, the energy sector is still very, very strong. It's at the highest RS ratio reading, meaning that that relative uptrend is still fully intact. And this combination of a weekly tail moving lower, almost vertically, losing only a little bit on the RS ratio scale, and a move like this on the daily very often aligns with a temporary setback. So that's how I'm going to read this rotation for the energy sector as well. What you also see is that the defensive sectors, utilities, staples, healthcare, they're losing relative momentum, but they are still on the right-hand side of the graph, meaning that their relative uptrends versus the S&P 500 are still there. Real estate. The weekly tail for real estate is the lowest in terms of relative momentum and almost crossing over into the lagging quadrant. But you can see the opposite move happening on the daily, where the real estate tail is inside improving and moving towards leading. That's sort of counterintuitive. And mind you, we just spoke about real estate. We're going to watch about the seasonal effect for real estate in a minute when we look at the individual charts. So we've got real estate rotating, I think, kind of negatively on the weekly, but it's almost offset with the rotation on the daily. And on the seasonal pattern, real estate is doing really, really well, or we expect real estate to do really, really well. So we're going to check that out when we look at the individual chart. We had a similar situation with energy, where we the rotation is negative, the daily rotation is negative, and we expect that from a seasonal point of view, especially from the average performance, the average outperformance, or in the case of the energy sector, the average underperformance versus the S&P 500, this pretty much aligns with what we see there. Seasonality, average percentage of underperformance over 2% for the energy sector in July, and it looks as if the energy sector is going through a setback. So that aligns with that seasonal pattern that we see there. Real estate is different, because here the rotation is pointing towards a negative rotation on the weekly, but the daily rotation is more in line with what the seasonals are suggesting us, where real estate is one of the stronger, or maybe the strongest sector going into July. So we're going to look at that on the price chart in a minute as well. And then we've got communications and technology that we need to check out. On the weekly, both are inside the improving quadrant. Communication services picking up, technology picking up, predominantly on the vertical scale, on the momentum scale. So they're picking up in terms of relative momentum, but not yet so much in terms of relative strength. That's higher on the RS ratio scale. If we check that out on the daily RRG, and we'll find the technology sector, then you see that it is smack in the middle, so that's in line with the market. Technology, biggest sector, is sort of dictating what's going on there. That means that there's not going to change much here, so this rotation is probably going to continue. It's going to, sort of minding its own business, doing its own thing in line with the market. Not much deviation to gain there, meaning that this move here, for the time being, I think, is also still a temporary move. And that aligns with the seasonal, where you can see that the technology sector is expected to do pretty good for this month, and also quite good for the next month. Communication services, if we align that, then you see that communication services is here inside the lagging quadrant, and you can see that we saw that little bit of improvement, and now it's already moving lower on the RS ratio scale, very stable on the momentum scale. And you see that it is still, it's not the lowest anymore, that's discretionary now, but it's the second lowest reading on the RS ratio scale, meaning that it's still in a relative downtrend versus the S&P 500. That does not align with the seasonal expectation for the communication services sector. Let's put the cap weighted, which I have on the left, side by side but with the equal weighted, because when we look at the seasonality, maybe we need to look at a bit broader market. Although the data are coming from the cap weighted, maybe I should do the same exercise and see if we can come up with that table with the data using the equal weighted sectors. Maybe that could give us a little bit more reliable data. So that's another thing that I have to add to my to-do list. But for now, I want to check out the side-by-side comparison for cap weighted and equal weight, because there is a few sectors that are showing some differences. Let's see what we can learn from those. Communication services is different. You see that the cap weighted is already way up in the improving quadrant. The equal weight is still inside lagging, picking up a little bit, but not much, and at a very short tail. The combined information here is that the communication services sector, in my view, is still in a relative downtrend versus the S&P 500, and the positive reading that we could get from the seasonal pattern, I think, is negated by the current rotation. So I'm not going to get any serious call to action from that rotation. We go to consumer discretionary. That's interesting. It's the other way around, because here you see that consumer discretionary is deep inside the lagging quadrant, stable and moving lower into it. But on the equal weight version, the tail is already inside the improving quadrant and showing a much more stable trend heading in the right direction. That tells me that the mega cap stocks inside consumer discretionary are holding the sector down. Under the hood, the broader base for consumer discretionary seems to be improving. And that could be a positive for the market as a whole. Keep that in mind. If we go to staples, then we see that's almost the same. Cap weighted is a little bit ahead of equal weight, but the pattern and the rotation is kind of similar. Here we see energy, and we see a similar move. That is, you know, big move lower, big move lower. We've seen the tails. We're going to look at the individual chart. It's in line with what we expect from a seasonal perspective as well. Here is the financials tail. That's also quite similar, although I do think that the equal weight is showing a little bit more upward momentum, telling me that, like consumer discretionary, the broader base is improving, where the larger caps, which are in the cap weighted in the S&P 500, are dominating from a negative point of view. So the members obviously are the same, but when you make them all equal, then the broader base is actually looking better than the cap weight suggested. Here is healthcare, and that is quite interesting, because here you can see that the big names are holding up. They're holding up that tail inside the leading quadrant, and you can see that that equal weight went through a negative rotation and now is, last Friday and today, actually rotating back in a positive fashion, or last week and this week. This week is only today. And that is sort of counterintuitive to what's happening in the cap weighted. That's sort of stalling right now. Here you see a return back from the equal weight stuff. So it is getting back in line. It is a defensive sector, and it looks as if it's going to stay on the right-hand side of the graph, meaning defense. Here's industrials, where there's quite a bit of difference. Here you see the cap weighted is inside leading. Sorry, cap weighted is inside leading and starting to drop lower on the momentum scale. And you see a similar effect in equal weight, although it's still inside improving but already losing relative momentum there. So for industrials, the larger cap is holding up the rotation for the industrial sector. Here's materials. These are, I say those are the same. Here is real estate. We saw that from a positive point of view on the seasonal pattern. The equal weight is moving rapidly lower into the lagging quadrant, which is in line with what we see with the cap weighted, but we've seen the daily tail already improving. Kind of difficult. We're going to look at the individual chart in a minute. Here is technology. I think that the equal weight is ahead of the cap weight. You can see that it is moving higher up. The tail is longer, so the base is better for the technology sector, which is in line with what we're expecting from a seasonal point of view. And then we have the utility sector finally, and that is similar rotations for equal weight and cap weight. Let's wrap that up with a look at the individual charts for the sectors that we just discussed. If we start with communication services, then we have the tail inside improving, and the seasonal suggests a strong outlook for July for the communication services sector. The trend here, I'm afraid I have to say it's still lower. There is upside for a bounce, but combined with the position of that tail inside improving, it's possible, but it's not a very strong sign. It's not a very strong signal. And I'm afraid the same goes for the technology tail. It's inside improving, it's going up. But if we look at the individual chart, then we have to admit that on this weekly chart, there is still a downtrend in play. Yes, we are testing support around that 125 area. If you look at the daily chart and you plot an RSI or a MACD, you'll probably get some positive divergences. So within that bigger picture, there's room for a bounce, there's room for an uptick. That could align with that short-term improvement that we see on the RRG, but again, it's not a very nice, strong alignment that makes you go like, yes, this is very actionable. The real estate seasonal suggests a very strong outperformance for the real estate sector. But look at the tail, that's not telling me a really good story, at least not on this weekly. The daily was a little bit better, but this is still not very good. And if you look at the price chart, then, I mean, I could argue that we've completed that head and shoulders pattern and we've actually reached the target area in terms of price. So there is room for a bounce, but look at those overhead resistance levels. There's plenty of overhead resistance. So here also, the current rotation and the price chart, it doesn't show a really strong alignment of seasonals with current rotation and a nice development on the price chart. And I've always learned, when in doubt, stay out. So there's no reason to actually, we don't need to trade, we don't need to invest. Now the one that I think for this month makes most sense is energy. Energy sector is in a very strong relative uptrend. However, it went way up. We broke a lot of resistance levels and we came hard down a couple of weeks ago and we're now digesting that move. And it wouldn't surprise me if that seasonal weakness that we are reading from that seasonal table and we see that weaker rotation on the RRG gives us a pause, maybe a little bit of a decline inside the energy sector, which could bring the price lower at least there is enough room for relative strength to move lower without harming that relative uptrend. And that would give the tail time to digest that move, rotate further into weakening, and maybe even curl back up without hitting the lagging quadrant. This move could easily be 3 to 4, 5 weeks. So if you really want to go for some sort of seasonal trade, I'd say that it is having a pause or looking for better entry opportunities inside the energy sector. That would make a lot of sense to me. If we then wrap it up with the S&P 500 chart, we saw some improvement for technology, maybe communication services, maybe real estate. There are under the hood some good things in the S&P 500 going on, but in the bigger scheme of things, and this is a daily chart because I wanted to show you the gaps that are, I think, forming overhead resistance areas, and we see that today, this Monday, we already stalled around that 390 area where the upper boundary of that gap area was. If we really get more follow through, then there's again new resistance just below 400. You can see this chart, the upside is absolutely littered with overhead resistance. So short-term bounces, yes, very well possible. The longer term trend, I remain very, very cautious for the S&P 500. And that wraps up Sector Spotlight for this week. Thank you for watching, and please remember, Sector Spotlight airs every Tuesday from 10:30 to 11 AM Eastern. Looking forward to see you again next week, same time, same place.